Welcome to the Deep Dive. Today, we're taking a closer look at Ellington Credit Company.
That's right.
We're digging into their recent earnings call, the one covering the first calendar quarter of 2025.
And, it wasn't just your average quarter. This was really the run-up to a pretty major strategic shift for them.
Exactly. So we've got the call transcript, the materials, and our goal here is to pull out the key insights, the really important nuggets, and figure out what it all means for you.
Yeah, calendar Q1 was definitely like a prelude. The Q1 numbers ending March 31st tell one story, but the bigger picture, the one management seems focused on, is that strategic transition that happened literally the day after the quarter ended, April 1st, and what they've been up to since then.
Okay, so let's start with those calendar Q1 results then. March 31st endpoint, they reported a net loss, 23 cents per share.
Yep, that's the GAAP number.
Yeah.
But alongside that, you've got adjusted distributable earnings, ADE, which actually came in positive at 26 cents per share.
Right, the ADE, often seen as maybe a better gauge of cash flow for the dividend.
That's the idea, yeah. And their net asset value, NAV, which, remember, they used to call book value, now it's NAV, that was $68 per share at March 31st.
Okay. And the net interest margin overall, that actually ticked up a bit.
It did, yeah. Increased by 20 basis points, up to 5.27%.
But then the economic return for the quarter, which factors in that NAV change plus the distributions, that was negative 3.2%. So kind of a mixed bag on the surface for Q1.
Definitely a mixed bag. And like you said, it really needs that context. This was the quarter before the big change. The really significant event was April 1st, the successful conversion to a registered closed-end fund. I mean, this was a big deal for them.
Years in the making, wasn't it?
It was. And they moved fast right after.
Yeah.
As soon as that conversion happened, boom, they sold off the rest of their agency mortgage pools.
And covered the TBA shorts. Right?
Covered the TBA shorts. And management made a point of saying this liquidation, this sell-off, had a really minimal impact on NAV, like maybe a penny per share, which was right what they'd estimated beforehand.
So no surprises there. And that exit from agencies, that was crucial because it allowed them to pivot, right, to really sharpen their focus.
Exactly. All focus now on the CLO market.
Yeah.
That's the strategy. The conversion also means their fiscal calendar shifted, by the way. It now starts April 1st.
Oh, okay. And reporting changes too for investors.
Yeah, it does. So instead of the usual 10Qs and 10Ks you see from regular companies, they'll now be filing things under the 1940 Act, forms like NCSRs, NSNs, NPRTs.
Different regulatory framework.
Totally different. Though they did say they'll keep doing quarterly earnings releases, sort of like they always have. And they clarified that the NAV per share metric is, essentially the same thing as the old book value per share metric. Just a name change, really.
Got it. Okay, let's swing back to Q1 performance then, inside the portfolio. You mentioned the headline numbers were mixed. Why was that?
Well, if you break it down by strategy, the CLO portfolio actually had a negative contribution in Q1. Cost them about 24 cents per share.
Okay, negative on CLOs. But the agency side?
The agency portfolio, the part they were exiting, that actually chipped in a positive 8 cents per share for Q1.
Huh. So the part they were getting rid of actually helped offset some of the paper losses on the part they're focusing on during that specific quarter.
Exactly, just for Q1. Digging into the CLO side a bit more, the negative 24 cents was mostly because of mark-to-market losses. So the value of their holdings went down on paper.
Right, price declines.
Price declines, yeah. And those declines were bigger than the net interest income they earned from the CLOs, and also bigger than some modest gains they had on credit hedges.
On the flip side, the agency portfolio.
There, the net gains they made on their actual agency mortgage-backed securities, the RMBS holdings, those gains were actually larger than the net losses on their interest rate hedges.
Including those TBA shorts they had on.
Including those TBA shorts, yeah. Which they then closed out right after quarter end.
Okay, so that performance happened against a pretty wild market backdrop in Q1, didn't it?
Oh, yeah. 2025 started off pretty strong, yawn. Feb felt okay. But then March threw a curveball. Suddenly there were all these fears popping up.
Like what?
Well, talk about new tariffs, potential tariffs. That got the market worried. Signs maybe economic growth was slowing down. And persistent worries about inflation sticking around. The usual suspects lately.
Right. And that combination sparked volatility.
Big time. You saw a surge in volatility for both interest rates and credit spreads. Equity markets took a dip, and credit spreads widened out quite a bit.
And that included CLOs?
Absolutely. CLO mezzanine tranches, CLO equity tranches, their prices saw some pretty meaningful declines in March. But here's the interesting part, management's perspective on this.
Okay.
They viewed those CLO price drops as being driven more by worries about potential future credit issues, especially linked to those macro fears like tariffs, rather than problems with the current or near-term performance of the loans inside the CLOs.
That's a really key distinction. Betting the market was reacting to fear, maybe overreacting, not necessarily to current bad news in the underlying credits.
Precisely. And they also pointed out how U.S. CLOs behaved versus European CLOs during that time. Europe was apparently comparatively more stable, especially the mezz tranches in Europe held up better.
Which kind of highlights the value of having that geographic diversification they've talked about.
For sure. It showed up right there in Q1. And, this volatility, especially the spread widening in March and carrying into April, that created the exact kind of buying opportunity they were positioning for with the conversion.
So the timing actually worked out for them post-conversion.
Seems like it. They jumped in right away in early April, using the increased liquidity and buying power they got from the closed-end fund structure. Management specifically called the timing opportunistic. They felt they were adding really attractive CLO assets during that market dip.
And then things reversed somewhat in May.
Yeah, May saw a bit of a snapback. You had some significant de-escalation on the tariff front, which helped calm nerves. Credit spreads tightened back up. Prices recovered a good chunk of those March and April losses.
So where does that leave their CLO portfolio now?
Well, as of the day before the earnings call, their total CLO portfolio was up to $284 million. That's up from $250 million right at the time of the conversion on April 1st.
So they put capital to work.
They did. They bought an additional $51 million worth of CLO investments just since April 1st.
And the strategy going forward is basically more of the same, selectively adding.
Pretty much. Selectively adding investments, both in CLO mezzanine and CLO equity, especially when volatility picks up. They talked about actively trading the portfolio too, looking for relative value, and leaning on their risk management. A big emphasis was also on keeping plenty of liquidity, that dry powder, ready to deploy if markets get choppy again.
Makes sense. What did they say about that liquidity position? How much dry powder do they actually have?
It looked pretty substantial. Going into May, their combined cash and unencumbered assets, stuff they could easily sell or borrow against, totaled $169 million. That was like 74% of their total shareholders' equity back at March 31st.
Wow, that's a lot.
Yeah. And specifically in cash and cash equivalents, they had about $59 million coming into May, which is almost 19% of the total portfolio value. So definitely holding cash.
Okay. And leverage. Are they levered up much after the conversion?
Actually, no. They said leverage was sitting at less than half a turn of debt. Pretty low. And they made an interesting point that their ability to grow the portfolio isn't really limited by traditional leverage constraints as much anymore.
How so?
It's more about their internal risk management, how they view portfolio composition. They think they could comfortably hold, well over $300 million in CLOs, even with their current equity base, partly because the closed-end fund structure gives them more flexibility in how they account for financing, like repo financing.
Interesting. More flexibility there. Any other plans on the financing side?
Yeah, they mentioned plans to add some corporate debt to their liabilities later this year. They expect that to be accretive, meaning it should help boost net investment income per share.
Good for potential earnings.
Right. And they also think it'll improve their overall risk management from a longer-term funding perspective.
Okay. Let's talk dividends. What's the outlook for adjusted distributable earnings covering the dividend?
So they were upfront about it. They confirmed they might be slightly short of covering the dividend in the current quarter, calendar Q2. That's the quarter ending June 30th.
Okay, a temporary shortfall, possibly.
Possibly. But the key message was they remain on track, in their view, for dividend coverage to resume in calendar Q3. So the quarter starting July 1st.
Got it. And they're adding more transparency, too.
Seems like it. They started putting out monthly tear sheets on their website. These give updates on NAV and other portfolio metrics more frequently than just quarterly.
That's helpful for investors.
Yeah. And they also threw in a comment that their performance in April compared pretty favorably with other CLO-focused closed-end funds. So a little positive signal there about how the new strategy is working out so far.
Okay, so if we boil this all down, the big takeaway for you, the listener, is really this conversion and the strategic pivot. That's the main event.
Absolutely. It positions the company squarely in the CLO market, a very focused approach now.
And management seems to embrace market volatility, not fear it. They actually see it as an opportunity, right? A chance to buy when spreads widen because of macro scares, not necessarily because the underlying loans are going bad.
Exactly. Which explains why they've been leaning back into mezzanine CLO tranches recently. They see compelling value there, decent yield pickup, plus it adds some balance and maybe some protection if those tariff or growth fears do eventually trickle down to loan defaults. It's a relative value play.
And that diversification we mentioned earlier, US versus Europe, equity versus mezz, that clearly helped them buffer the Q1 volatility.
Definitely showed its worth. And even though they've deployed some capital since April 1st, they still have significant dry powder. They stress that. They've got capacity to grow the portfolio more.
But they're managing it dynamically based on opportunity, leverage, risk frameworks, using hedges.
Right. It's not just buy and hold. They sound ready to put more capital to work if they see the right chances.
What about bigger picture trends? Did they mention anything about like new money coming into CLOs, say from 401ks or ETFs?
They touched on it briefly. They noted the main impact they've seen so far is probably in the CLO ETF space. That demand might be helping keep the prices of the safest AAA-rated CLO tranches tight.
Which could affect the arbitrage, the economics of creating new CLOs.
Potentially, yeah. But the broader impact of, wider investor access on the whole market structure, that's still kind of an unfolding story.
Okay. All right. Now for our favorite part, the segment where we absolutely stress this is not financial advice. Just a hypothetical exercise, connecting some dots from the call. If we were, say, analysts at a scrappy hedge fund pitching a trade idea based on all this, what might it sound like?
Okay, here's the pitch. All right, team, listen up. Spreads tightened in May, but the macro picture, still murky, right? Let's call it the tariff hangover with relapse potential. So the play is a volatility capture barbell.
Oh, barbell. Okay. Intriguing. What's on the ends?
One end. We go long those discounted US CLO BB tranches that kind management scooped up in April. We're playing the yield carry, betting the actual credit holds up better than the March-April freakout suggested.
Okay, long the riskier mezz, betting on fundamentals. What's the other end?
The other end. We synthetically short agency MBS basis, use TBAs. Basically, we copy management's successful Q1 hedge and take advantage of the new derivative flexibility this closed-end fund structure gives them.
So hedging the macro risk, potentially profiting if things get volatile again?
Exactly. It's not just market beta, it's a thesis. Strategic opportunism meets structural arbitrage. Payoff. Nice carry on the mezz, plus asymmetric upside if volatility flares. And you do it within this now more flexible, closed-end fund wrapper.
Outrageous, but plausible based on the call themes. Definitely not advice, though.
Absolutely not advice, just connecting ideas.
So wrapping up this deep dive on Ellington Credit Company, we saw them pull off a major strategic conversion, navigate the related Q1 transition results, get out of the agency business efficiently, and then start deploying capital opportunistically into CLOs during that recent market wobble.
Yeah, the clear message is they're positioned now with a focused CLO strategy, dynamic approach to capital, and a lot of liquidity, aiming for future earnings growth.
And one last time, everything we've discussed here is purely for informational purposes. It does not constitute financial advice. Please do your own research. So here's a final thought to leave you with. As more capital chases yield in complex areas like CLOs, how might these shifts in investor access, things like CLOs potentially entering 401k plans, the continued growth of CLO ETFs, how might that fundamentally change the structure of this market and the opportunities available for active managers in the future? Something to chew on.